Investing is a long-term game that will increase wealth over time, and it almost always necessitates regular investing. The consensus among experts is that consistent savings over time can make typical people wealthy, but market timing is a losing endeavor. If you were to receive a sizable inheritance or money from a lottery win, would it make more sense to split the sum up into smaller amounts and invest a certain amount regularly over time? Or would you rather dump all of that money into the stock market at once and reap the benefits? Most investors use dollar cost averaging, many of whom don't even realize it while reaping the benefits. Should you store up cash and keep quiet until something happens when experts forecast an impending recession? What is dollar cost averaging, and how can you use it to your advantage? In order to use cost averaging, a regular payment must be made to your retirement or investment account on a set schedule, such as weekly, bi-weekly, or monthly. Others might decide to perform the transfer manually since they are independent contractors or their employer doesn't provide investing services. This approach can be equally effective, but it involves more time, consideration, and labor, which isn't always desirable. This is particularly undesirable for those who experience anxiety when the market fluctuates. If you invest in a 401k, it may be advantageous to remove emotions from the equation by employing an automatic investment approach because market changes are common. Most likely, you're using the dollar cost averaging investing technique, which is seen to be the most secure and will give you the best long-term returns. Dollar cost averaging is the practice of investing a specific sum of money over time in the same stock or fund. In other words, the same sum of money will be invested on a regular basis regardless of the asset. If you regularly contribute the same amount through your 401k plan out of your paycheck, this could entail buying the same share on a monthly, weekly, or other fixed timetable. You are taking advantage of this if, for example, you have an IRA to which you make weekly contributions. The funds are directly deducted from your bank account and invested automatically in the S&P 500 fund. For instance, by investing in the fund with a defined dollar amount and on a set timetable, you are already utilizing this method. Most people who follow this method really don't care what the price per share of an S&P 500 fund is at any given time, as long as their money will be there when they retire, even when the price of the S&P 500 moves up and down. This is an excellent investment strategy for novice investors since it enables them to profit from market downturns by acquiring additional shares at a cheaper price. Using this method couldn't be any easier if you didn't have the nerves that some investors frequently have when they watch the value of their investments decline. Anyone with a suitable investing account is eligible to benefit from this strategy. Some people have their accounts set up so that when money is deposited according to a predefined schedule, it automatically invests in the chosen vehicle. The simplest application of this technique involves doing nothing at all. Other investors opt not to use automation, which necessitates that they regularly buy shares by hand. The manual method is more difficult since it takes time to make the purchases and because emotions are more susceptible to market changes. The identical dollar amount of shares are bought regardless of whether the acquisitions are automated. Invest $100 in the same stock as an illustration each week. The price of the stock may fluctuate over the course of a week. It may be priced at $10 one week, allowing you to buy 10 shares, $20 the following week, allowing you to buy just 5 shares, or $5 the following week, allowing you to buy 20 shares if there is a sale. Depending on the stock or fund price at the moment, a different number of shares will be purchased. When investing, disregard market fluctuations, even if the economy crashes and other investors start selling everything out of fear. If the share price declines, your money will purchase more shares. If the share price rises, it will buy fewer shares. Automating this will lessen the possibility of panic when economic uncertainty dominates the news. The issue is that many small investors panic when the market becomes erratic and sell off at the worst possible time before just starting to invest again when everything is looking good. This is a classic error that occurs during every recession. And while the general public is in a state of panic, major institutional investors are benefiting greatly by taking advantage of equities' rock-bottom pricing. Let me know in the comments if you have any other questions about investing. Let's return to the video. According to Warren Buffett, a sizable portion of his fortune was amassed by buying investments at a discount during the Great Recession and holding them until their values increased by using a dollar-cost averaging method over an extended period of time. The absence of emotion in the game allows you to profit both in difficult economic times and prosperous ones. The average cost per share decreases over time as you buy more shares while the market is down, making this strategy, despite its simplicity, an extremely effective and strategic way to invest. This approach is very helpful for novice investors who are just getting started and want to increase their position. If you had just won a windfall of $100,000, would it be prudent to invest the entire amount at once in the stock market? Or would it make more sense to buy $10,000 worth of shares gradually over a few months? Since it is hard to foretell what the markets will do next, and investors have no understanding how to forecast the future of stocks, investing money over time is less risky. You can find so-called experts making radically divergent forecasts on when the next recession will happen by reading a few investment news pieces. Some said there isn't one in the near future, while others believe there will be one. Stocks plummeted 5 years ago due to impending unrest, or they might spike suddenly owing to good economic news via dollar-cost averaging. Basically, varying the price at which investments are purchased ultimately lowers your risk by using this investing approach, which also tends to take the emotions out of the game when the market is either doing very poorly or reaching all-time highs. You may worry about other things that may be more useful, like your budget, family, and profession, if you set aside the same amount of money each week. The majority of people are better off financially focusing on ways to maximize their time productivity and revenue while working and automatically investing. We've seen it happen before. Mom-and-pop investors frequently panic when there is a stock market disruption and prices begin to decline modestly. When the market finally comes around and recovers, they stop investing money and occasionally sell everything. Although the majority of the profit has already been realized, these folks start making contributions to these accounts as soon as their confidence returns. By this point, you can keep your portfolio on the back burner while going about your daily life if you set up an automatic payment to your investments on a monthly basis and set it and forget it, so to speak. Assume, for instance, that starting in January, an investor will contribute $1,000 on the first of every month to index fund XYZ. Like any investment, the investor's fund fluctuates in value and price from month to month. Despite this, the investor consistently invests $1,000 on the first of every month, regardless of the number of shares the money buys. In January, $1,000 purchased 50 shares. In February, it purchased 62.5 shares. In March, it purchased 83.3 shares. In April, it purchased 58.2 shares. In May, it purchased 43.48 shares. The $5,000 investment has grown to $6,817 in just 5 months since the investor started making contributions to the fund. The investor now owns 298.14% of the company's stock. The share's typical price is $16.7. If the investor had spent the entire $5,000 all at once at any given time, the $5,000 investment would have grown to $6,850 depending on the share's current price. The overall profit during this time could be bigger or lower, but by spreading out the purchases, the investment's risk has been significantly decreased. If the investor had bought all the shares on one day, he might have been fortunate if the price was low, but he might also have been unlucky if he had bought on a day when the price was high. If an investor chooses to invest in a lump sum all at once, they may strike it fortunate and buy two markets at the bottom. But it's also possible that they may buy at all-time highs, so employing the method isn't certain to provide you the best return. Limiting returns lowers your potential risk when you make a series of smaller purchases over time. It makes sense for people to use this tried and true tactic because timing the market rarely works. Even seasoned mutual fund managers struggle to surpass the benchmark. You might receive larger rewards in addition to having lower risk. Furthermore, dollar cost averaging is possibly the simplest investing strategy you could ever employ. Don't be fooled into thinking you can limit losses by selling your investments when you believe the market is headed lower. Instead, keep investing the same dollar amount consistently and take advantage of lower-priced investments. When the assets increase in value, simply buy fewer shares of the same dollar amount. This method has helped millions of people grow their 401k accounts, so it might help you too. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.